While every major news outlet in Britain screams about property market collapse and post-budget chaos, something extraordinary just happened that nobody's talking about. Building societies quietly moved £7.5 billion worth of new mortgages in just 6 months. 7.5 billion. That's not a market in freefall. That's not panic. That's serious money flowing into property while everyone else is watching the sky fall. So what's really going on here? Is the UK property market secretly thriving behind a curtain of doom-laden headlines? Or are we watching the early stages of something far more complex unfolding right before our eyes? The answer might surprise you, and it definitely doesn't match what you've been reading. If you want to cut through the noise and understand what's actually happening in the UK property market right now, hit that like button and subscribe to Property Reporter so you never miss the real story behind the headlines. Between March and September of this year, building societies increased their total mortgage balances from £485.5 billion to £493 billion. That's not a slight uptick. That's sustained, deliberate growth in an environment where we're supposedly witnessing market carnage. And here's what makes it even more interesting. We're not just talking about your traditional building societies here. This figure includes mutual-owned banks like Virgin Money and the Cooperative Bank, institutions with serious lending power and serious appetites for property investment. While economists debate and headlines shriek, these lenders pumped billions into the housing market without fanfare or celebration. The disconnect between what you're being told and what's actually happening with lending couldn't be starker. Money is moving, capital is flowing, lenders are backing property. But if that's the case, why does everything feel so broken? Because while building societies are opening their vaults, the companies actually building homes are getting destroyed. Vistry Group, one of the UK's major house builders, just posted results that should make anyone pay attention. Their profits didn't dip. They didn't decline modestly. They collapsed. We're talking about a 55% drop, leaving them with just £40.9 million in profit for their half-year results. 55%. That's the kind of number that signals something fundamental is broken. Weaker buyer demand is hammering construction companies, even as mortgage money flows freely. Think about that contradiction for a moment. Lenders are willing to lend, builders are desperate to sell. But buyers aren't buying. The money exists, the properties exist, yet the market is seizing up like an engine without oil. This isn't about supply or demand in isolation. This is about an affordability crisis creating a bottleneck that's strangling the entire system. Builders can't sell what people can't afford to buy, no matter how much money building societies are willing to lend. And the reason people can't afford to buy comes down to one stubborn problem that refuses to go away. Interest rates. The Bank of England has been treating rate cuts like they're made of gold, doling them out in microscopic amounts with painful hesitation. Every cut is cautious. Every move is calculated. Every decision is slow. And while the bank sits and deliberates, mortgage costs remain elevated, keeping property ownership out of reach for thousands of prospective buyers. This isn't abstract economic policy. This is real paralysis affecting real people trying to make real decisions about their futures. Buyers are stuck in an agonizing waiting game, hoping rates will drop further, but watching property prices hold steady or even edge upward while they wait. The math never quite works. The timing never feels right. And so people wait and wait and wait some more. What we're left with is one of the strangest market dynamics in recent memory. Lending is available, terms exist, money is there. But for the average buyer, the cost of that money still feels impossibly high. The door is open, but the threshold might as well be a mountain. Yet, despite all this, there's a curious undercurrent of optimism brewing in certain corners of the property world. Industry insiders aren't ready to write the obituary just yet. Following the latest Zoopla House Price Index and the post-budget environment, property professionals are cautiously, carefully, tentatively hopeful. The bet they're making is simple. Greater fiscal certainty could unlock the pent-up demand that everyone knows exists but nobody can quite access. Government policy clarity, they argue, might be the catalyst this frozen market desperately needs. And here's the strange part. The week immediately following the budget, the one that was supposed to trigger market apocalypse, according to pre-release speculation, actually performed reasonably well. Not spectacularly, not catastrophically, just reasonably well. The sky didn't fall, transactions didn't evaporate. The market absorbed the news, shrugged, and carried on. It's almost as if the doomsday predictions were overblown, almost as if the reality on the ground doesn't match the panic in the headlines. But that hope comes with complications, because just when you think the path forward might be clearing, another curveball arrives. Lloyds Banking Group just announced changes to procuration fees starting in January 2026. If you're not familiar with procuration fees, they're essentially the payments mortgage brokers receive for arranging your loan. And Lloyds, one of the biggest players in UK banking, is about to restructure how those fees work. This could fundamentally alter what it costs to get mortgage advice. Brokers are going to face different economics. Borrowers might face different costs. The entire advisory landscape could shift. And for anyone trying to navigate a property purchase, this adds yet another layer of uncertainty to an already complex process. Will advice get more expensive? Will brokers change how they operate? Will borrowers end up paying more out of pocket? Nobody knows yet. But the announcement alone is enough to make people pause, reconsider, and wait just a little bit longer before pulling the trigger on the biggest financial decision of their lives. And in a market where hesitation is already the default mode, that's not helpful. So we're left with a market caught in a strange, self-reinforcing loop. Economic uncertainty is crushing buyer confidence despite the fact that financing is available. People could borrow, people could buy, but people won't, because the future feels too murky and the costs feel too high. And when buyers sit on the sidelines, the effects ripple outward in predictable ways. Rental demand is already increasing as purchase decisions get delayed month after month. Landlords, nigh of whom were supposedly facing extinction just a few years ago, are suddenly finding themselves in a position of unexpected strength. As more would-be buyers become long-term renters, rental properties become more valuable, and rental income becomes more reliable. The market is showing resilience in the data. Lending figures prove that. But behaviour tells a different story. Behaviour shows caution, hesitation, and a collective holding of breath. People are waiting for something to change, but nobody's quite sure what that something is. And here's where it gets personal, because these abstract market forces translate into very real consequences for very real people. If you're a homeowner right now, your property values are probably holding steady, but don't expect meaningful growth. You're not losing, but you're not winning either. You're treading water in a market that can't decide which direction to swim. If you're a prospective buyer, you're caught in that awful middle ground where mortgages technically exist but don't feel affordable, where properties are available but don't feel like good value, where timing never feels right. You're stuck between wanting to act and feeling unable to. If you're renting, the outlook isn't much brighter. As the purchase market stalls and more buyers stay in rental properties longer, competition for rentals increases and pressure on rents continues. You're likely facing sustained or increased costs with no clear path toward ownership. And if you're a landlord, well, you might be one of the few groups looking at this situation with something approaching satisfaction. The shift from buyer to renter benefits you directly. Demand for your properties is up. Your investment looks more stable. You have a window of opportunity that could last well into next year. So what does all this actually mean for the UK property market as we head toward the end of 2025 and into 2026? We're looking at a market presenting deeply contradictory signals. Strong lending figures that suggest health and vitality. Weak buying behaviour that suggests fear and paralysis. Post-budget clarity that might, just might, unlock the stalemate everyone feels but nobody can quite break. Some experts believe that 2026 could be the year things finally shift, the year pent-up demand gets released, and the market starts moving again. Others worry we're headed for further stagnation, more months of waiting and hesitation, and frozen decision-making. The deciding factor will almost certainly be interest rates. If the Bank of England picks up the pace on cuts, confidence could return quickly. If rates stay elevated, the waiting game continues. But there's another possibility worth considering. one that doesn't get talked about enough. What if we're not watching a market that's broken? What if we're watching a market that's holding its breath? What if all this money flowing quietly through building societies, all this lending happening without fanfare, all this behind-the-scenes activity is actually the foundation for something bigger? The contradiction between the 7.5 billion in new mortgages and the 55% profit collapse at Vistry isn't necessarily a sign of chaos. It might be a sign of transition. Markets don't move in straight lines. They pause. They recalibrate. They wait for the right conditions. And maybe that's exactly what's happening right now. The question we should be asking isn't whether the market is broken. The question is whether we're witnessing a market holding its breath before something significant happens, or whether this is the calm before a correction that nobody wants to admit is coming. 2026 will give us the answer. Until then, the UK property market remains locked in its strange contradiction. Money flowing, buyers waiting, builders struggling, lenders confident. Which signal is the real one? Time will tell.